Why do you remain negative on this market as we make the turn into the fall?
Yeah, so there remained significant headwinds that are in front of us, and I think looking forward. So I think we've looked at a few different things. So number one, this is a late cycle economy. We've looked back, and I would define the cycle by unemployment rate and how much you've grown since the last recession. We're at the historic low unemployment rate, and nominal growth has already risen 40% since the recession of 2020. Number two is people talk about the delayed impact from rate hikes as being kind of not a big deal. We think it's pretty significant because it really has effects on the consumer, on businesses, on commercial real estate, where all of their paper gets rolled, right, on a rolling basis every few years. And right now, over the next 2 years, you're going to be rolling a lot of 0% paper into today's interest rate. And it's not only the consumer and businesses, but it's also the federal government, right, who has a exploding deficit, which is going to significantly increase the amount of treasuries they're going to have to issue. And that's part of the reason why we're seeing the higher interest rates. And that capital has to come from somewhere in order to absorb that supply. And I think equities will be one of those places.
The crux of your argument is you ain't seen nothing yet. Like, whatever you think about the economy being, allegedly stronger than expected, it's all going to, normalize or worsen or weaken once all of the things you think are going to happen actually happen.
Yes, exactly. Like we've been talking about the excess savings declining. San Francisco Fed thinks it hits zero by the end of this year. We've talked about the student loan moratorium ending. That's ending right now, and the first payments come in October. We've talked about these payments having the interest rates, rolling on commercial real estate. There's about $1 trillion coming due in the next 2 years. That's on the come. We talk about tightening lending standards. That's not something that hits the economy right away. That takes time. That's a lag. And so whether this pushes us into a very strong, vicious recession, or it is a slowdown from here, we think categorically there's going to be a minimum a slowdown in economic growth, and earnings estimates are not pricing that in.
Okay, so John, the bottom line here is that Eric thinks stocks are just simply too expensive where they are even now, based on what's still to come. What's your response?
So good to see you, Scott. So definitely some stocks are expensive. Stocks are re-rated tremendously. I mean, the Nasdaq's up close to 40% year to date. That was the most beat up index. It was down 35% peak to trough. So no doubt we have seen a big retracement. There are pockets that are expensive. But I do think there are areas that have gotten cheap. Maybe where I differ with Eric a little bit is I think some of the areas that have gotten the most interesting are the areas that are being most impacted by the higher rates. For example, you're seeing many of the REITs trade at some of the steepest discounts to their history and peers going back over the last 5 and 10 years. And it's definitely true that there are many of these are going to have to refinance some of their debt, but I think that you're getting that priced relative to where they've traded historically. And if you think about those valuations in tandem and relative to the tech valuations, I think investors have to get more excited. I mean, investors have gotten pretty sanguine about the multiples in the tech space. And I find this ironic because interest rates have not come down. If anything, they've gone up. And this was the very reason people sold technology. So now you have a situation where technology is re-rated. It looks very pricey in certain pockets, and the more interest rate sensitive areas look quite cheap. So I think those areas definitely warrant investor attention. And I think you're getting much of that priced, even though we could be late cycle. I mean, if we are late cycle, I would expect actually some of the REITs, utilities, banks to actually do better given where interest rates are today.
I mean, his argument is that stocks are just too expensive now. And once, the real effects of what the Fed's already done start to take hold, once the consumer weakens, once the economy then starts to weaken further, that there's no justification to keep stocks at this level, no less expect they're going to go up from here.
Well, I wouldn't totally disagree with that. I mean, you're paying 18.5 times for the S&P, and that's a very tech-heavy index. If I look at the Russell 2000 value, which has a greater dominance in financials and REITs, or the Russell Midcap value, those indexes, Scott, are trading at just 10 times earnings, 8.5 turn discount. That is material. So I want to repeat that. 8.5 turn discounts with yield premiums with growing dividends. And I think these areas are set to outperform. And what's so interesting is over the last 3 months, the Russell 2000 value and the Russell Midcap value have both been up about the same as the S&P. So they've been performing in line, but you're getting a steep discount in valuation. So I always think that valuations should shape investor expectations, and it's no different today. Many of the tech names and within the S&P look pricey, but you can look over in the value arena, and there's lots of opportunities that have discounted a slowdown, discounted the recession, and I think that is where investors are going to make their money in the back half of the year over some of these other pockets.